Hello everyone, welcome back to the channel. Thank you so much for joining me. Europe may begin selling U.S. Treasuries in response to a new conflict with the United States, and this move will trigger a collapse of the U.S. dollar. For many decades, as many of you know, U.S. Treasuries have occupied a very special place in global finance. They were not just another bond, but the ultimate safe asset, the ultimate safe haven asset, the bedrock of pension funds, central banks, and long-term investors around the entire world. When uncertainty rose, money from around the world flowed into U.S. government debt almost automatically. And that assumption is now being tested. It is being challenged in a way that we haven't seen for a very long time. This week, cracks in the US-led global financial system are widening. Denmark's Academiker Pension, it is a pension fund that represents academics and professionals, announced that it plans to exit US Treasuries entirely. Exit US Treasuries entirely by the end of the month. Not by the end of the year, by the end of the month. And the reason was not very technical, it was very political. The United States is basically not a good credit, said the fund's chief investment officer, and long-term, U.S. government finances are not sustainable. This is an extraordinary statement. This is an extraordinary admission from a conservative pension manager, especially one talking about the United States. You would agree. So without a doubt, more investors and more pension funds will fall like dominoes. They will follow suit because the risks are too high. The volatility is extreme. Washington has undermined global trust not only in its political institutions by now, but also in the Federal Reserve as its independence, as the Fed's independence is being not just tested, but challenged, destroyed in front of our eyes. The fund actually stated that U.S. finances are no longer sustainable due to weak fiscal discipline, which is true, a softer dollar, I just posted a video on that, and the push for Greenland. European countries own $3.6 trillion worth in treasuries, or 40% of all foreign holdings. If other countries follow and begin dumping treasuries, what happens? Yields will spike, and it will push U.S. borrowing costs to unprecedented levels. Eventually, this could trigger an implosion of global financial markets. On paper, the Danish pension fund may not be a market-moving giant. Its treasury holdings amount to roughly a couple $100 million based on reports, but the signal landed at a moment when global bond markets were already under severe stress, and Donald Trump's threats to unleash tariffs on former allies, the EU, those threats actually underscored the fragility of the global financial framework. U.S. Treasuries reopened for trading this week to find themselves caught in a perfect global storm. Japanese government bonds were in free fall, as you know very well, with yields on Japan's ultra-long 40-year debt surging above 4%, which is the highest level on record. That sell-off actually rippled outward, and it hit long-dated bonds everywhere from Europe to the United States. It is very interconnected. At the same time, political tensions were escalating sharply across the Atlantic. President Trump had reignited his aggressive push for American control over Greenland. Greenland is an autonomous territory within the Kingdom of Denmark. Once it may have been a highly provocative talking point that Trump absolutely loves, but now it actually comes with concrete threats that include tariffs on European countries that are used as effectively leverage in the Greenland dispute. Now, markets did react very, very fast to this dilemma. U.S. Treasury sold off hard in early trading. The 30-year yield jumped more than 10 basis points, nearing 4.95%. Again, this is the highest level in 4 months. 5- and 10-year yields pushed to levels that we haven't seen since August of last year. So it is clear that the common U.S. bond markets may have officially ended. Additionally, as I discussed in detail in my previous video that I just uploaded yesterday, the dollar is weakening. The dollar weakened this week as the result of Trump's aggressive foreign policy moves. It's led to a 2-week low. The United States is becoming the source, in other words, the source of uncertainty, not the safe haven from it. The Danish pension fund's decision didn't cause this move, of course, but it sort of amplified it. There will be more funds that will follow this example. There will be more investors and companies and countries that will follow this example without a doubt. The exit from U.S. Treasuries speaks to a broader shift in how global investors are reassessing political risk associated with the United States. It is too unpredictable. It is just a volatile environment, and there's just too much risk involved. This isn't happening in a vacuum. Japan's bond market is playing a very critical role here, despite what Scott Bessent made it appear to be. Concerns about Japan's fierce outlook and rising inflation expectations have pushed Japanese yields sharply higher. And I will upload an entire video on this, or I may write a post about this over on my Substack and Patreon. I haven't decided just yet, so stay tuned if you're interested. But this matters because Japanese investors are among the largest holders of foreign bonds, including U.S. Treasuries. And as yields at home rise, the incentive to repatriate capital increases, which means capital will leave the United States and will go back home. And that's where the real danger lies for Washington. If large pools of foreign capital begin flowing back home, not out of panic, but out of rational yield considerations, out of rational decisions, borrowing costs in the United States could rise structurally, astronomically. Japan may become the true accelerant behind both Treasury and dollar sell-off, between both Treasury and dollar collapse. Now, if we layer political risk on top of that, the picture becomes even more uncomfortable. Trump pushes uncertainty to its limits, and as a result, bond yields spike. Stocks wobble, stocks fall, the dollar weakens, and at that point, rhetoric softens somewhat because it serves as a rude awakening to the madness that we are observing right now. But this time, I would say, the stakes are higher. The Greenland dispute is not just another trade issue. It has raised many deeply uncomfortable questions in Europe. It has raised many questions about the global international system, the framework that has been in place for decades, and whether or not it still exists. The idea that European countries might weaponize, if you will, their holdings of U.S. bonds and U.S. stocks was once dismissed as unthinkable. Now it is openly debated. But let's be honest, the EU cannot afford to sell U.S. Treasuries. It can't. Its economies have been in a downward spiral for years, not months, not weeks, for years. Germany has deindustrialized. So the EU cannot afford a crisis at this point, and Washington knows it very well. But what Washington does not know, or what Washington refuses to admit, is that its pure aggression internationally causes the world to shift away from the US dollar, and as a result, from US dollar denominated assets, including its debt. If foreign appetite for US assets weakens more, the consequences won't be pretty. Higher yields mean higher borrowing costs for the United States government, higher mortgage rates for households, and more pressure on already stretched public finances. A $13 billion auction of 20-year U.S. bonds will soon gauge whether investors are still willing to absorb long-term American debt at current prices, and weak demand would actually send another clear signal that something fundamental is shifting. I will definitely keep you posted. The truth is, the United States no longer looks like a predictable actor. Its fiscal trajectory is strained, its politics are volatile, and its trade policy has become openly confrontational, even toward its former allies. A conservative European pension fund is no longer asking whether U.S. Treasuries yield enough, it's asking whether they deserve to be treated as risk-free at all. And that is a profound shift. And if more investors begin asking the same question gradually, without panic, rationally, the impact on global markets could be far greater than any single sell-off. Thank you very much for joining me. I hope that this quick video was interesting. Support my work. I truly appreciate every single one of you who has become a paid subscriber. And I look forward to seeing you here tomorrow. Take care.